I got to ask Charlie and Warren a question a few years back about their 100-year vision, because that's how families I work with think. But I have another question I never got to ask. Was there a master plan? 1969, Berkshire shares in the portfolio, in the wallet. Was there a master plan?
I wonder if I guess they had in their heads what it could be. But because they were always, the way they were structured was always to keep it down, to be humble, folksy, grounded. I think in the back of the head, they saw what that could mean. I mean, Buffett very early said he knew that he would be rich. So in his head, he could not help but understand that if he compounds at a certain rate, he'll be wealthy no matter what, because he had much more confidence than I have that his returns will be exceptional. And so he knew that. But then I think he took decision by decision, working day by day, building, and he called it painting his canvas. But I think somewhere he understood that this will be significant. He didn't know probably how much, but calling it a master plan, I wouldn't go that far. I think that word would not occur to him. He just wanted to keep building, and he understood, if I live long enough, then that it will be very big. And he also said that in one of the early letters, the important factor for long-term compounding is also living a long life.
Welcome to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest topic of all, money. How to make it, save it, keep it. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. My guests share their practices, principles, and evergreen wisdom. I'm your host, Bogumil, author, TEDx speaker, and investment advisor to wealth creators with patient capital and an infinite investment horizon. I work with families and individuals who aspire to grow wealth over a lifetime and generations through disciplined, thoughtful investments in durable, quality businesses, while giving money meaning. Join me on this quest to unearth and share the wisdom of the ages. Let me share with you the podcast program disclosure statement. Blue Infinitas Capital LLC is a registered investment advisor, and the opinions expressed by the firm's employees and podcast guests on the show are their own and do not reflect the opinions of Blue Infinitas Capital. All the statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. The information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. The information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. None of what you're about to hear is investment advice. You know how researching a company can take forever, digging through filings, transcripts, and reports trying to make sense of it all? That's where Tenzing Memo comes in. It's an AI-powered market intelligence platform that helps you research public companies in minutes instead of days. Created by stock analysts for stock analysts, people who love the treasure hunt of investing. I spent over 20 years investing professionally, and when I started using Memo, it immediately became part of my process. It surfaced new ideas, helped me spot insights on stocks I held for years, and connected data points I'd completely missed. It's fast, intuitive, and gives you a research superpower. Tenzing sponsored this episode to help us make Talking Billions better for you. Use code BILLIONS at sign up for an extended trial and 10% off. Check out Tenzing Memo today. My guest today is Robert Karas, partner and chief investment officer at Bank Gutmann in Vienna, Austria's oldest private bank, where he oversees investment strategies for ultra-high net worth clients. Robert is a seasoned investor on a lifelong journey, known for his thoughtful investment philosophy and engaging market insights. Robert, how are you? So nice to see you again.
Hey, good seeing you, Bogumil. Thanks for having me on your podcast. And I remember I've been on there already once, so I'm totally thrilled that you want me again. And I have to say, what you've done with your podcast is really amazing. So I admire your consistency and getting all these great guests and me.
I was thinking, I feel like a kid in a candy store. I get to spend an hour with people I like and have their full attention for, 60, 90 minutes and ask them about things that I love talking about. And it's just, I don't know, it's a bliss. So the fact that I can do it, it's a privilege, honor, and I'm really humbled and grateful that I get to spend this hour with
Wonderful.
you. I highly recommend to this audience to go back and to listen to that first episode we had together. But today I want to ask you about the work you've done recently. You keep writing, keep posting, and I absolutely love it. A lot of your writing is very personal. But you went back and you reread, to me, the famous letters that Buffett wrote about the partnership when he was managing the partnership between 57 and 69, a long time ago. But the ideas are still relevant today. I want to jump around those letters, and you might know already, but I want to ask you about some things that are the same, some of them that are different. There's a certain story you share from those letters about stock certificates and checks, and Buffett actually walking over and sending those and carrying them around. How do you think that has had an impact on how he was managing his affairs? How is it different today? It's been a while since I went to a bank to deposit a check, and it's been at least 15 years since I held an actual physical stock certificate. What was it like? Why did it matter? How did it have an impact on his process?
That's a good question. And I think, to my kids, I have to tell them what were the times pre-internet, what were the times pre-mobile phones. But both you and I, we don't know what were the times when Buffett was doing that. It was really, I guess it was standard practice back then. And it was the pre-electronic record-keeping time. I still remember reading a book about the 60s, and that's the time frame where the Buffett partnerships were active. And I still remember that they describe a paperwork crisis. So in the 60s, go-go years, trading volumes exploded, and people were schlepping suitcases of stock certificates and trade confirmations along Wall Street. And I think there was a big chaos, and sometimes stock exchanges even closed because they couldn't keep up with the record keeping. And it really took till 1973 when the TTC was established, so the Depository Trading Depository Trust Company. So that was the name. So it really took some time. I think everyone enjoyed the way it was, but then everyone was overwhelmed and so I guess people only change and find something new if there's pressure on them. So there was a big push to go electronic. Yeah.
Robert, I have a vivid memory of the early days when I joined an investment firm in New York 20 years ago. And I got to work, and I continue to work with families that have had wealth over multiple generations. Rhymes with your experience. And I remember going for bankers' boxes. I had to do some research. You do research these days in a different way, but just for the benefit for the audience, of this audience. I would go back and see the statements of some accounts that we were managing at the time, but these were statements from 10, 20, 30, 40 years ago. And I physically got to see the doubling of the accounts. I have no idea what the returns were. I think it's secondary for this conversation. But I actually saw the physical doubling, 2 turning into 4, 4 turning into 8, 8 and turning into 16. And by that time, it might have been, 64, 128, whatever. It doesn't really matter. But the point is that I got to see the power of compounding because I was holding those physical certificates. You can go online and see the statement and see a nice chart, but actually physically holding a statement dated so long ago, just like Buffett was, and thinking, wow, these amounts that we're co-managing today, they trace back to those statements that, the color changed, the print is not so good, but it's real. I don't know. I wanted to bring it up because I keep on thinking of compounding what it means, and the process itself, maybe sometimes slowing down a little bit, allows us to appreciate what it is that actually we're doing here, what we're responsible for.
Yeah, I also think we only understand it through over very long time periods. It gets more clear what compounding really means. Yeah, good point.
And the process itself, I mean, you and I are responsible for family fortunes, people's livelihood, and getting things done quickly. Yes, it matters, but also appreciating the process itself and having respect for it, I think it helps sometimes. I want to ask you about the fee structure. So there are so many people these days that they say they want to run the partnership just the way Buffett did. But I don't think they read the letters the way you read those letters. Buffett did a couple of things that were revolutionary. No management fee. Then profit sharing, only above a certain hurdle. But there's a part that a lot of us conveniently forget. Do you know what I'm talking about? The unlimited personal liability for losses. Wow.
Unbelievable.
Do you want to talk about that? I haven't heard anybody that claims to be managing a Buffett-like partnership talking much about that unlimited personal liability for losses.
Yeah, that's true. I mean, Buffett eventually got rid of it too. But you're right. Initially, it was also participating on the downside. And I'm not sure about all the details about the story, but if I'm not mistaken, one person took him up on it or so over the years. He says it somewhere, but I mean, he had great performance, so he never had to pay out money. But it was an interesting structure, and he played around with different fee structures, and then at some point, all the different partnerships were brought into one partnership with one fee structure. But nevertheless, it was a 0% management fee, incentive fee structure. But initially, he had also the whole downside. So I mean, talking about aligned interests. I mean, we all talk about it, but normally we do not share in the downside directly, right? And it's also, you can't run a business that way. That's the other thing. I mean, that's difficult, and it puts so much pressure. So I'm not sure.
The other thing that's unique about that period was that all the years, as far as I remember, were with positive performance for Buffett. I'm not sure about the market, but for Buffett. And I've met many managers managing money over the years. And it's, for all of us, it's hard to find a streak of how many years it is, 13, 14 years, with no year that's a down year, right? So when you're offering this unlimited, and I know it's short-lived and so on, but just as a principle, I think it shows the essence of who Buffett is. To have that streak of 13 years with no down year and being open to taking personal liability for losses, I don't know, it just made me pause and think. Very different. Very different.
I mean, if you look at that track record, I mean, that would have been enough to make him famous amongst the investors. Mm-hmm. What followed with Berkshire Hathaway made him famous to nearly everyone, but the partnership returns were just unbelievable and speaks to the large edge he had over others. It was a different time for sure, but it needed someone like Buffett to really exploit that gap, that knowledge gap or that research gap. The big edge he had.
Very concentrated, doing the actual work. And I was thinking about a bigger picture idea. When I'm looking at money managers, I got inspired in this business because of Peter Lynch. But by the time I picked up his book, he was no longer as active. Maybe he had some sort of a role still, but not active as much as he was when he was running the big fund. I see two kinds of managers, those that have an incredible performance over, 10, 12 years, sometimes shorter, and those that stay in the game for a lifetime. Do you have some thoughts about it? I think it's almost a different nature that some of us are drawn to one. I want to do it over a lifetime, but there are people that just want to have an incredible 10-year record, and then they're going to go fishing.
Yeah, that's a good point. I think for Buffett, Buffett is like the chess player of the stock markets or of investing. He just loves the game, is in for the love of the game, and there is no amount of money in the world that would stop him from doing it. And he has proven it at the age of 95 that has more money than we could even comprehend, and he's still loving going to the office every day and looking at companies, analyzing stocks, and so on. So love of the game is the big differentiator, that's for sure. And I think we'll be around as long as we are allowed to walk on this earth. We'll be around and doing it, I guess.
You're touching on something that came up in a couple of conversations I've had here. At the end this year, 2025, whenever people are listening to this, he decided to retire, semi-retire, however you want to call it. But there was this one point towards the end when he said, if the market is down, if there are a lot of opportunities, feel free to call me. And I saw in him, I mean, a little bit of, I can relate to that, right? I think we both can. He's basically saying, I'm not entirely done. I'm still enjoying this.
Exactly.
If I'm needed, call me. Is this something you noticed when he made that comment?
Yeah, I noticed on several occasions, because he also said, I'll hang around, and if I can be useful, I'm here. So he'll be around in the office and will not be short of an opinion. And also because I wanted to ask the question, that's why I now remember it. Because about the cash, about the big cash position everyone talks about. So I also wondered, was one of the ideas to give Greg Abel and the others more optionality, not a highly concentrated position. Whatever they do, it would be their error, or if it doesn't work out, so it gives them a lot of cash to do their own thing. But someone asked that question along those lines, and he answered, no, I'm very competitive. I would not leave an opportunity to Greg. I would grab it myself. So he was like, ooh, I'm still here. I'll take that opportunity. So yeah, that also changed my mind about the cash position. So it really seems that there's nothing attractive enough for him at a big size. I mean, we all know that at a smaller market cap level, I think there is plenty of opportunity, but it wouldn't move the needle for Berkshire, so he needs much bigger size, and in that category he doesn't find anything to put the money to work. That's my opinion.
Buffett grew as an investor. He changed, but one aspect that stood out to me reading your letter and listening to you now, I think it was very, very important for him to have an incredible track record at the beginning. And then he realized, look, I'm still young. I might do it for another 45 years. My track record will not be what it was the first decade, but I still want to stay in it. And I think he had a hard time with that realization, and that's why, many reasons, but he's decided to shut down the partnership. But he was repeatedly talking about him not being able to repeat the returns he had so far. And then sort of it became... He brought it up many, many years since, but it became less important. He realized, I just want to stay in this pursuit over the long run. Having a very, very high return over a short period of time is no longer the only goal I have. Do you have some thoughts about it? Is that something you noticed?
Definitely. And I mean, he started talking about we can't do it again, I think, from year one, because
yes.
he either said we will not be able to outperform the index by that big margin again. We will not be able to this and to that. And then he did again and did it again and did it again. And then he closed down the partnership and he did it again with Berkshire. So he was always keeping the expectations low. But then he delivered and over-delivered. So that's just incredible.
He continues to do so. I want to ask you about the location. So reading the letters, I got reminded yet again, he was operating this partnership from Omaha. And you and I know Omaha today. And I've seen Omaha change in the last 2 decades. But I can't even imagine Omaha in the 1950s. I mean, I'm trying. But moving to Omaha...
He grew up there, so it's different, right?
No, I know, but it's a place where I would imagine you go to retire or pick up another hobby, not to stay plugged into Wall Street and investing. But he used that to his advantage. And I think there are others that followed, I mean, including Templeton and our mutual friend Guy Spear, I think benefited quite a bit from moving away from New York. And I mean, the beauty of Switzerland by itself, but I think just for the ability to think. Do you have some thoughts about it? Moving away from Omaha in the 1950s, from the heart of Manhattan.
Yeah, I mean, I think he was raised there. He loved the lifestyle, loved the people, and then he went to New York, and so he experienced what it was like to be in New York. And some people they just love it, they love the vibe and the energy. And I think he was more distracted maybe, so he didn't see any advantages. But I think also that if you're the one who's really on top of I don't know what I should call it, but I think he was like the mastermind within what he did and his universe. So what additional good would it do to talk to many other people who know less, who do less work, who have a different opinion, a different strategy? I think it's all a distraction, and it would dilute his essence that he had. And so to protect that essence, I think it was better for him to move back to Omaha. And at the end of the day, there was still the love of the hometown. So I think he just wanted to live there. Certainly was another factor. But he experienced New York and he saw no advantage to what he did.
Complain today that there's so much noise. And I think I was even thinking about it, how I was consuming news when I started, which is, 20 some years ago. There would be a newspaper that ended up on my desk or an article that somebody brought to me. Hey, look, somebody wrote up a stock you were talking about. But there was a lag and a delay, and it was slow. And now your phone is vibrating. If you have a smartwatch, it's pinging, and it's like no end. There's no way I can miss that. This or that stock was up 3% yesterday. I can't, even if I'm completely tuned out. So I can see the benefit. I want to ask you about some of the early investments he made. Dempster Mill, and I want to bring it up because Buffett is a nice guy, and I think he has a hard time with some harsh moments, but he had to make some harsh operational decisions. Can you talk about that? It was the moment he had to fire workers, close plants in a small Nebraska town. How do you think that experience shaped his later choices, and how he thought about the people that are behind those businesses?
Yeah, I think it speaks to that we all live within our bubble and how we look at the world. And he thought of himself as, I'm saving Dempster Mill because without me, the whole company would go bust and disappear. But because I'm here now and requesting change, there will be a future. But the people living there, the people working there, they experienced it differently. They experienced that someone is coming in, firing people, bad capitalist type. So he got angry letters. So he was not on Twitter back then, getting angry commentaries. So we got it by snail mail, yes. Angry letters by people who said, "You're not a good guy." I think he was shocked. He didn't really see that coming, and so I think that was the moment where he said, "I don't want to experience that one. I don't want to experience that again." But I mean, he still saw that in some companies, especially if he had control, changes are needed and tough decisions are needed. But he then always got someone else to do it for him. Right? So yeah. I think that was he didn't like it. Yeah.
I think it's a realization that some of us have at some point that. To me, I discovered Peter Lynch and I got to work for an investment firm in New York. I realized there are people behind portfolios, but then there are also people behind the businesses we invest in, right? And what seems like a faraway operation in a small town in Nebraska, this might be the only place where people can get employment in that town in a meaningful, big numbers. So it's something that I think he appreciated and noticed with Berkshire Hathaway itself. And with a shoe company at some point too, and others. I think it was an eye-opening experience. Robert, I want to ask you about American Express. I think a lot of Buffett fans remember the salad oil scandal. But what I want to point out is that he built a large position Not only that, but he was building it as the stock was crashing, which you and I know it's a hard thing to do, right? It's the stock is down already, and you bought some, and you feel like, oh, I got it cheaper. But when it's still falling, it's hard. Can you take us back? What was it like to have the conviction and the commitment to the idea when the price is telling you that you might be absolutely crazy?
Yeah. I mean, the salad oil scandal, I won't go into it. If someone's interested, they could read it up. But the point was that the big question was now what will happen to the American Express brand because of the scandal. So that was the important question for him, because he thought there was the credit card business was already there. It was very strongly positioned. There were also the travels checks. And he said these businesses are very cash generative, very successful. But if people then lose trust in the name American Express, in the brand, would that business suffer? So he started talking to everyone. So he went into full scuttlebutt mode to try to find out more about the business. And then he found out that people are still using the traveler's checks. They're still using the credit cards. I think they didn't even know about the salad oil scandal. They might have read it in the newspaper, said, okay, fine. But they didn't care. They just loved the convenience of the products, and didn't put a tent into the business. And that for Buffett was the signal. I can get that business at a big discount because of this scandal they will be able to go through it, and so he loaded the boat with it, and then the stock started recovering. And if I'm not mistaken, wasn't American Express at some point 40% of his partnership? So it was a huge position after the gains, after the profits. Talking about concentration, right?
I mean, yeah, the conviction behind it and going against what the market is telling you. You're pointing out something that I find fascinating, and there are many ways that we can find an advantage, but we both would agree, I think, that the market sometimes focuses on something that's very near term, and it's not really affecting the actual business. And we might be wrong about it, but there are moments like this where, as you said, people were using American Express, the brand and the products, no matter what. The oil scandal, and people can, of course, read more about it, had nothing to do with the actual business. It was just a poor decision and had consequences, and, pricey consequences that eventually got, the consequences got limited for the arrangement that was made, and so not as bad as people thought. But there are moments in time, especially in the public markets, where we're all looking at just one thing, and the stock is down 50%, and we're forgetting that customers are still going and shopping there. Customers are still liking the product. Customers are still lining up to renew, upgrade, or whatever it is. And whatever we think is the news of the day, going back to the earlier conversation, what we should filter out, is bringing the stock down, but not the business down. I think that's the bottom line. I want to ask you about Disney. Disney back in the day, not today, back in the day. There was a personal meeting that Buffett had, and Disney explained the company's strategy to him. I mean, what a moment to sit down with Disney and hear about it.
The man himself, Walt Disney, right?
Yes, the man himself. So a couple of things, direct access to management and being so close to the idea. But the catch is that he ended up selling Disney, and I think regretting it a little bit. Can you talk about it, meeting the management, being in the right place at the right time, and then selling it?
That's true. And there is, if people are interested, there's a 1991 university speech by Buffett where he talks about Disney, so you get all the details there. I think that's interesting. And when he took the position, that was in 1966, so really a long time ago. And Disney obviously was a different company, but they already had a lot of assets. They already had the park, or some parks, or one park, I'm not even sure, and intellectual property. And Buffett wanted to see Mr. Walt Disney at the age of 35, and Disney never heard about Buffett. Why should he? But he gave him the time and the talk to, and Buffett realized what the assets that are part of Disney and the cash flow they produce and the IP that will be there for generations, and new children are born every day that will love the brands in the future. He said, I think the stock market valuation was 80 million, and he said in a privately negotiated deal, if you wanted to have a part of Disney, probably you would have to pay a company capitalization of 300 to 400 million, and the stock market valued it at 80 million, and that speaks to that what you said before. That's why we're all in the stock market. We hope to find these situations, and then his analysis was right. But I think the curse was that he made 50% very quickly, and then he saw probably other opportunities in the portfolio that he wanted to invest in. So he said, "Oh, I'm up 50%," and just sold and moved on. Sometimes quick profits and large profits can also be a curse, because then you miss probably the multi-year compounder. And we all know how it is. If you sell something for X and then it's suddenly 2X, you have a hard time to go back into the stock.
It's the sugar rush and the confirmation that I was right about something. He was right about it.
Yeah.
But I think it's a bigger picture idea. I mean, there's so many things about the Disney story, and the fact that he was generous enough to meet him, and Buffett, called on and took buses and trains to meet people in general, which I think was eye-opening and I think educational to all of us. But it's this transition that I talked to Chris Mayer about, the 100 Beggars author, how the early value investing education that we get is finding the dollar bills for 50 cents. And Buffett made most of his early money finding those. They were available still. They were available to Ben Graham in the 30s, but they were still around in the 50s. But Chris pointed out to me that sometimes it's worth paying $1 or a bit more for a $100 bill. And I think that's what Buffett grew to appreciate. Talking to Disney, he was looking at a $100 bill that was available probably at a dollar or a bit more, just for the sake of the argument here. And I think that
would have been fantastic to hold it, for sure. Yeah.
Anyways, food for thought. Robert, there were different categories of investments that Buffett was making. The generals, the workouts, the controls. How that approach has evolved as the capital base grew. New partnerships, more clients, more partners he was accepting. How is that evolving and changing year to year? And then what was he learning from it?
Yeah, I also wondered why he really categorized it in these three buckets, and probably is for him mentally to sort them, also make it more understandable for his investors, because the generals that was the generally undervalued securities. That was the biggest bucket. I think it was still quite concentrated there. So he invested 5 to 10% in each one of the positions, and normally held like 5 to 6 positions. So that was a big chunk of the portfolio. But when the market became more expensive, he found less opportunity there, and he liked to do more workouts also, because there it really depends on the corporate actions. So that would be an event-driven fund today, right? Where you have mergers and spin-offs and some other reorganizations where you can make the result through your activities. And he also said that he had a much higher degree of confidence because he knew what the end result would be. And what people forget is, because Buffett always talks about the dangers of leverage, but there he took leverage. So he took leverage of 10 to 20% on the invested capital because it was often like an arbitrage situation. And I think in the prospectus, or at least in the letter, he said that the maximum he would apply there would be 25%. So he was even willing to put some leverage on there. But often there was not enough to do with him work out, so he looked at other situations. And then the third category, controls, that sometimes often came out of the generals, because first he found something that was deeply undervalued, and then he established a position, and then he got bigger and bigger up to the moment where he had a control position, or he wanted a control position because he saw that he has to do something to make it happen. So in that sense, he was quite activist. Mm-hmm. So he had all these different parts of the portfolio, and depending where the opportunity was, depending on the market situation, he would have more of that or more of another category.
Three very different when you think about it, right?
Yeah.
They could be three different funds that should be focused on one thing, and he was doing it all. And I can't forget it.
All in his one mind. This is unbelievable. It's like a multi-strategy fund, one person running it.
Speaking of running to the bank to deposit the checks and carry the stock certificates, putting them in the vaults, and he was a busy
I think
man.
It also has to do with low cost and control were also factors why he did all them himself in the beginning.
100%.
Understanding
100%.
every little part and.
Well, speaking of that, there was somebody that was helping him at some point in the 60s. The name is Bill Scott. He comes up in the letters and in your notes. Buffett's associate in the 60s, who eventually accumulated, from what I remember from your notes, $4.5 billion. I don't know at what point was that, might be more today. But first of all, what does it tell us about the exposure to an exceptional investment thinking early on? And like the true power of compounding. Somebody was helping him out. I don't know what Bill Scott's role was. I'm sure he was carrying some of those checks. $4.5 billion. Not an executive of a big bank, just somebody that was there at the right time. Is Bill Scott still around? I don't even know.
I don't think I did some research back then, and I found that he signed the giving pledge, and that's where these amounts came up. But what you can read in the letters is that he was an early employee helping Buffett with all the stuff that was going on, all the administrative stuff. And Buffett then very early disclosed not only what he had invested and his wife Susie had invested in the partnership, but also the whole family, and also what Bill Scott has invested. So he was very transparent with that, putting them all out there. And so what you can see is that Bill Scott every year put money to work there. So first and foremost, it tells you that working for the right people is important. And then believing in them, and then not only, your salary depends on it, and then you put your money with the person too. So you need a lot of trust to have both of the things going on. But if it works out, that's just amazing, because he put money to work every year, and that compounded, and the original money compounded, and the new money compounded, and eventually made him a billionaire. Unbelievable.
You point out something that I don't want to miss, the fact that Bill Scott was putting his own money into the fund, right? It's such a different way of thinking than I see, and probably you see in the public markets today, when employees, I'm all for employees being, co-owners in the business, but they're granted options and shares. And sometimes it's in really large numbers relative to the actual profits that the business has today. I'm sure you know what I'm talking about. That leads to an inflation of, the share count and so on. It's such a different mindset than Bill Scott earning his paycheck, which I'm guessing was not big, and putting some of that money into the fund because he believes. So it kind of cuts both ways. One, the disclosure that they are invested in it, and then the fact, what a vote of confidence in what he's a part of, instead of Buffett granting him vesting options and LP interest over time because he's even here. I have to say it. It's a different mindset, isn't it?
Yeah, definitely. And I think that also, if you read his letters and you read how much money the family had in there, his sisters and all his friends and people. So, if that would not have worked out, I'm not sure how happy he would have been in Omaha, Nebraska, because, so many people trusted him with their money. Unbelievable. So it's truly aligned interest, yeah.
Huge responsibility. And I asked our mutual friend Guy Spear about it. We met at Value X. That Guy organized this wonderful event in clusters. But I asked him when he was on the show, because the early money that Guy was investing was his father's money. And I had to ask him about it because I sit down with families that I meet for the first time, and they decide to commit their inheritance to me. And he told me what I feel and resonates with me. He said I was shaking. And I still get chills, remembering the moment when he told me that, I was shaking. If you're not shaking, accepting somebody's, lifetime of earnings or an inheritance, you might not be cut out for this job, because it's a huge responsibility, even without the fee setup that we talked about with personal liability. The fact that you are responsible for somebody's livelihood, you have to pause for a moment and think about it, and maybe shake a little bit too. Do you have some thoughts about it?
Definitely, it's a big responsibility, and I think if you really like taking that, and then you also feel like a protector of these people. It's not only, people always talk about performance and benchmarking. Have you outperformed the benchmark and this and that? But that's not the most important thing. The most important thing is that you say, okay, I'll do it for you, and if you trust me and if you stay with me, we'll come out ahead. But if you lose your trust during difficult times, then the results will not be good. So we have to establish that trust now during good times, and then we'll live through the bad times that will come together. So you have to do a lot of work in the beginning to be sure that this is the right fit. And I often say, if you don't like that, what we are doing, then you should not be a client. You should go somewhere else. And I think that's important. You should not take clients at any price, because there will be an unhappy path for both parties if there is no fit. So, and Buffett did that through communicating through his letters. He always said, that's what I do, that's what I stand for. Yes. And now everyone says, okay, how great it was. But at that time, who knows? Nobody knew if he would be successful. He was extremely young. And they said, I guess there were some 50-year-old that said, what is this 20-something guy talking? He's too young. He doesn't know. I would never give him my money. So, yeah.
Pretty remarkable. So many things here. Somebody pointed out to me something that stayed with me. I'd like to have clients that I'm looking forward to talking to and meeting and seeing for lunch. And that alignment, that works both ways. They feel like I'm the right person. I'm not the right person for everyone. I'm not. Maybe I'm a person for very few, and that's absolutely fine with me. But the people that choose to have me in their life and I choose to have in my life, Robert, at the end of the day, I want to be looking forward to the calls with them and lunches. If I'm not, I think it tells me something. And I think it's a wonderful thought and a test both ways, if they're looking forward to seeing, right? And it goes beyond the benchmarks and statements and everything else. It's just on a human-to-human level. Is this the person you trust with money that you can't replace? The money I call it the money that my clients don't immediately need, but the money they can't afford to lose. I think it's a huge revelation.
That's a good point, yeah.
There was a moment with the partnership, 1969. I believe it was the best year, 58%, 1.8. People can look it up, 59, whatever it was. Huge year. But he decides to shut it down. Yet again, not a common practice in the investment profession. When you're managing clearly for performance, and then you have your best year and you say, there's too much speculation in the market, I'm gonna shut it down. We have to talk about it. What were you thinking reading that letter? And to me, anybody else would say, I'll keep going even if the returns are half of what I just had. But he said no, which is the importance of the short-term track record for him at the beginning, I think. He says, I don't want to ruin the track record. What were your thoughts?
Yeah, it's really astonishing. He did over 58% gross, and that resulted in 45% net. And he started writing in the letters that he's less hungry than he used to be in the beginning, and that he assembled quite some assets. What were the numbers? 6-7 million at some in 66, or when he disclosed it in one of the letters, and you have to take it by 10 at least for the day. So maybe he was at 60, 70, 80 million at that time. So he was already quite well off. And who knows, maybe he had already some ideas for Berkshire or doing something else. So I guess, I mean, we only know what he was willing to share with us, and there might have been other inputs as well in his mind to change that. But it was also the time, he could clearly see there was some excess in the markets. I mean, in the 1968 letter, he writes about that one big investment manager, he didn't name them, but he said they had over $1 billion under management, and they just launched a new advisory service, and there they said, oh, today everything is so complex, it's not enough to do it on a month-to-month, week-to-week, or day-to-day basis. You have to do it hour by hour, and you have to be super active and blah, blah, blah. And Buffett said, wow, he wrote in the letter, I now feel guilty if I grab a Pepsi. Yes. So he was making fun of it. But I think he could feel that if this bubble bursts and if a bear market is upon us, he would also have a hard time running the partnership maybe. So there were a lot of factors, I guess, why he decided to shut down. And then with the shutdown already, they decided to keep Berkshire Hathaway and some other companies, and so he had control positions there. So he knew there would be something to do, and he will keep on painting his canvas. So, yeah.
he wasn't done yet. But the point you're making, he was no longer doing it for the money. And probably by that time, it had been a while that he wasn't doing it for the money anymore. And I come across people in this profession that clearly no longer do it for the money. I mean, we do have to pay bills and we have responsibilities, but I think you and I would agree that there are moments like this last Friday. If this was just a job, 5 o'clock, I'm shutting down my laptop. But I came across something about a stock that I was looking at. And I'm lost for the next 2 hours, going back through transcripts, just trying to, I heard something. Can I find it? And I'm looking and you know exactly what I'm talking about.
That's funny.
And I don't even know if I'm going to use it. I don't even know if it's going to add value to the portfolio, but it's just part of it. I love the research aspect of, I'm building a stock portfolio, I'm managing money, but at the end of the day, it goes all the way down to the smallest thing. For Buffett, it was carrying that stock certificate to the bank. For me, it's looking up this one little fact. If this was a job, I'm already gone. It's not a job. It's something I just love doing. And I'll stay the extra hour. And I think that's where the real difference happens. Do you have some thoughts about it? Do you catch yourself doing that too?
We are obsessed nerds, that's for sure. Yeah, it's very difficult. When I have some meeting coming up or lunchtime with someone, I have to be very careful not to start reading something like 10 minutes before I should leave, because then exactly that could happen. Then suddenly an hour is always said, oh damn, I completely forgot I should have gone somewhere, because you really get into this rabbit hole and say, where did I read it? What did the guy say? And what was the situation there? And so it never stops. Yeah, I can exactly see where you're coming from.
And it's curiosity. It's learning. I told somebody that it's a license to learn. To me, investing, it's a fascinating intellectual puzzle. And yes, it has its financial benefits and it's helping people in many different ways. But at the end of the day, I just love the pursuit of working things out and connecting dots where maybe people are not seeing those dots. And I just find it very alluring. Robert, I want to ask you about a concept that maybe some people are forgetting, the cigar butts. And it's going to lead me to Berkshire and set up the stage for the future of this endeavor that Buffett was on. The Sanborn Map Company. It was, I think he bought it below the liquidation value, a traditional cigar butt. You can tell us what it is. There were still quite a few of those available in the 60s. And then, they pretty much disappeared. Maybe some people can find them in the macro cap world still today. I'm not sure.
Probably.
What was it all about? What drew him to it? what's the whole story? And I think that's going to tell us how he ended up holding Berkshire.
Yeah, I think Sambor Map was a tremendous business because they had all these maps with all the different details, where is what in the town and in the buildings, and all the insurance companies needed it, and it was a low capex business. So you didn't have to invest a lot to keep it up, and the prices you could ask for they were very high, and so there are a lot of surplus capital. And they invested, and then at some point, the business was not as good anymore because there was a different technique that replaced it, but there was still cash generative, so they started early on to invest the surplus cash into a stock and bond portfolio. And when Buffett invested, he saw that if they would distribute that part of the company, then he would make a lot of money, and the business would be better off as well. I mean, it's just like a Japanese situation today, maybe, because still, despite the changes, a lot of Japanese companies are very overcapitalized, but you never could get to the treasure, but it is changing now. But I'm digressing. So there are some comparable situations today, I guess. But eventually he was successful, but with a lot of work behind it again, and the board that wasn't willing to change. But at the end of the day, they weren't willing to have a proxy fight, so they distributed the surplus cash to shareholders, and everyone was better off. I think today the problem really is that to make the change happen, you have to get to a control-like situation, and that's often difficult because in Europe you have these holding companies, but their families are in control, and they might have different targets, and they then might not be interested for the stock price to go up because then there might be more inheritance tax. Similar situation in Japan, but yeah. So I think you can find things like that, but you have to be very careful not to be trapped somewhere and nothing happens forever.
I wrote an essay that got more attention than the other ones, and I'm always surprised which one will get more attention. But I called it "The Expensive Truth About Cheap Investments," and I described this idea that dawned on me after many conversations here and with friends, how we got attracted to value investing because we have a bit of a frugal bone in us, right? That's why we have the capital to start with, because we spend less than we make. And then at some point we realize that quality matters, and then at some point you have to pay up for things. And I think it's a very hard realization. I've seen a lot of much more experienced value investors with a few more decades than I have. They go through this, and Buffett himself went through this. But I find it fascinating, the cigar butt, there's a limited upside to what it can deliver, right? Like you can't expect a cigar butt to be a lifelong investment, 100x. It just doesn't work that way. The physics don't allow it. But if you buy Disney when you just met Walt, anyways, just a thought. Robert, 13 years of the partnership, started with $105,000, $105,000 and $100, and then he distributes all of it. But what does he really do? There are Berkshire Hathaway shares in the mix. I have so many questions about it, but do you think he knew at the time that Berkshire will become really the reincarnation of the partnership? And was there a way to tell that it can become such a huge success? Berkshire was a textile mill, terrible business, a cigar butt investment, just along the lines of all Ben Graham 1930s investments. And here we go. He has it. He gives it to the partners who might have not even understood exactly what is it that they're holding. Just yet another, Sanborn map kind of company. Can you walk us through what do you think was going on? Could we, if you and I were there and we just received those shares, I don't know if I would have decided to hold them. Would you?
Really, we cannot really say what we would have done, I think. I mean, there were a number of people who who followed him, because I think amongst friends and family, he made clear what his decision was, and he made clear what he expected from them, I think.
Yes.
And also over the years, I think his expectation was that you never sell a share. But you still, I think it's a lot of trust in the person, and also for me as an investor, because you talked about the different journeys that we all have and how we develop. I think what I noticed in myself is that I'm the management, the CEO is much more important to me than it used to be. Because if you're a cigar part investor, you don't really care who the manager is. But if you want to have a lifelong compounder, it's important who is at the helm. And I think the people who really trusted Buffett and who experienced these tremendous years in the Buffett partnership, they said, oh, I want to stay with the guy. Whatever he does, I want to do the same. I think there were plenty of people who did that. And one part of it is that he was very smart how he communicated, because he made sure that every year you got the religion again, and that you understood what he was doing, and that you sensed that he was onto something, despite that Berkshire could have ended up as a disaster, because if he would just kept the textile mill, that would have gone to zero. And I mean, they even reinvested money, and then that lowered the prices, and the returns on capital went down. So it was a death spiral, or not a positive thing for sure. But then he pivoted, as we would say today, and he added new businesses, he added insurance companies, and so on. So there was a lot of work to do that one could not foresee. But what people already knew is that there's someone who's really smart, and he hasn't lost any of his edge and smartness. So they want to have a part of it. So a lot of people stuck around and got very, very wealthy because of it. I think Omaha is a rich town today because of Buffett, a big part of it.
You're touching on so many things, and I'm going to pull on one thread, but every year I go to Omaha, I run into somebody that has owned shares for a long time. And I want to tie it, well, I'll come back to it. When I asked them why, politely, I realized that most of those individuals, usually it's a couple, they had no expertise to read an annual report, understand the statements, and say, this makes sense. I know what he's doing, and mention all the things you said, the reinvestment, high return, use of capital, allocation, all the terms that they wouldn't even know what I'm talking about. But on some level, they said, here was a guy that spoke our language. We knew what he was doing. We trusted him. So one decision. And the second, and Munger talks about it, I think in many ways, that not selling it, right? Not selling it over decades. I think it's even harder than buying it in the same way with Disney, right? He bought the right thing but sold it. They didn't need to have AI, didn't need to have technology and analyzing 20 years of transcripts and come up with a summary. They just knew. Can you talk about that phenomenon, and maybe merge it with AI taking over our research efforts? And here, you and I meet those couples every year in Omaha and probably many other places that didn't need it.
I mean, because you mentioned Guy, so I met Guy Spear in 2002, and he convinced me to go to Omaha together. And I'm forever grateful to him, because it opened up the world. So I knew about Buffett and read about it, but going there was a different thing. And I still remember during the meeting, I was sitting next to a woman. I'd say she probably was in her 50s or older, I don't know. And she even asked a question or something. And then she said, my grandfather bought Berkshire shares. And then she even said how many shares, and that they are still holding it. And so the first thing was, okay, it traveled through generations. And how difficult is that? Because businesses often do not travel. They somehow, things get lost over generations, even if you do not have inheritance tax, because there are more children and there is maybe fight about the money, blah, blah, blah. But some families, they moved, they passed it on, and then there's this thing around it, there's some magic around it, and who wants to be the first generation that sells it down? So you're very careful with that, I guess. But then the funny thing was sometime after she raised the question, I said, oh, what did she say? How many shares? And then I calculated in my head that they were worth, in 2003, they were worth like 200 million or so.
Incredible.
We're talking big numbers here, right? And so also at that amount of money and different amounts of money that are very large, it's not about you have to sell to buy something, because they probably sold some shares to now and then to do something with it. But the remainder, they just hold on to it. And so the decision is, what shall I do now? Shall I sell it? And what do I buy with it? Because if they sell it, often there's a big tax bill. So that's also, in a way, that's good, right? Because that's also a barrier to quick selling. Because if you sell, you have a very small entry cost, and then you have a big tax on it. So you're very careful to say, oh, maybe I give it to I donate it, I don't have taxes on it, or do something else with it. So that's a good thing, and it somehow is transformed. It's more than just a stock investment. It's something entirely special. And then you go to the meeting, and you're part of this community. And Munger often called it a cult-like community. And it is a cult. It is a cult. That's for sure.
It's an experience, and Omaha changes for that weekend, or the week really, to a completely different place. I tell my wife every time I go that there's no other place on earth that for a few days I have more friends per square mile than anywhere else I can think of. And any place I stop, there's somebody walking over saying hello. And it's just a phenomenon. We're talking about business and capitalism and profit. He built something bigger. And I think that's the true legacy, that I am embracing what it means. I have one last question. And it's a big one for me that I've been pondering. I got to ask Charlie and Warren a question a few years back about their 100-year vision, because that's how families I work with think. But I have another question I never got to ask. Was there a master plan? 1969, Berkshire shares in the portfolio, in the wallet. Was there a master plan?
I wonder if they... I guess they had in their heads what it could be, but because they were always, the way they were structured was always to keep it down, to be humble, folksy, grounded. I think in the back of the head, they saw what that could mean. I mean, Buffett very early said he knew that he would be rich, so in his head, he could not help but understand that if he compounds at a certain rate, he'll be wealthy no matter what, because he had much more confidence than I have that his returns will be exceptional. And so he knew that. But then I think he took decision by decision, working day by day, building, and he called it painting his canvas. And but I think somewhere he understood that this will be significant. He didn't know probably how much, but calling it a master plan, I wouldn't go that far. I think that word would not occur to him. He just wanted to keep building, and he understood, if I live long enough, then that it will be very big. And he also said that in one of the early letters, the important factor for long-term compounding is also living a long life.
Yes.
And he got lucky that he had that. I mean, I guess he didn't do anything special to have it. I've not read anything but about Coca-Cola and burgers and steak. So I'm not sure he was into continuous glucose monitors and biohacks. I'm not sure.
Not in this lifetime. The reason I'm asking, it dawns on me how we see in the corporate world those master plans. We'll be the number one, we'll be this and that. And what I'm getting from all those meetings that I've attended is that they were trying to do the right thing again and again and again. And the powerful thing is, and I think comes across through this conversation, they were doing the right thing even if nobody was watching, even if somebody was not in a position to evaluate that that's the right thing. They just knew it. The couples that you and I were talking about, They just understood and knew who those two are and how they go about life and doing business, and they didn't have to have extensive analysis and research and AI tools. On a human level, they knew they can trust that duo, and I think that's the biggest thing I walk away from this experience. And finding people like this in life, and not necessarily running businesses, but your doctor, your dentist, your lawyer, your accountant, your money manager, whoever. I think it's a precious asset to have. Your friends, of course, right? Somebody that you know that will do the right thing, even if you're not watching, even if you don't know what the right thing is. So many times in life we just don't know. We trust the doctor to tell us the right thing. It's such a powerless moment in our lives, and to have somebody that does the right thing because we trust them, I think it's something that I walked away with from all those meetings. Robert, this was such a wonderful conversation. I'm so grateful you sat down, read those letters. I'm grateful you shared it with all of us. And I was delighted to read them. I reread your notes, and I have a million more questions, but I think we touched on the essence of what's in those. I highly recommend for this audience to look up your LinkedIn and follow your writings. You share so much. I don't know when you have the time to write all of it, but it's all very beautiful and from the heart. And I feel like each time I get to know Robert a bit more. So I'm very grateful for this conversation and all the work you're doing.
Thank you, Bogumil. It was great to be on the podcast. And someone said, it's not good on LinkedIn to mix personal with business. But I think that's my thing, to mix personal with business. Everything else is boring. And I think people go to these platforms because they want to connect with other people. And if you don't share anything about yourself, how should anyone connect with you? And you're the same. I think people following you know who Bogumil is, and I appreciate what you're doing. And your podcast just exemplifies that. And keep the good work. Keep the good work, and I'll be one of your super fans.
I really appreciate it, and it's very kind of you to say that. I'll just mention one thing that popped in my head. When I shared a draft of my book that I wrote years ago, Money, Life, Family, with a good friend, a mentor. I'm not going to mention the name. I'm hoping he's going to be on this show one day. Very private individual. But he read it, and he sat me down in his office. He said, "This is a very intimate book." And I said, well, clients come to me with one of the most intimate things that they'll ever experience in their life. I have to be the same way with them, don't I? That's the reality I see, the same we talked about Guy Spear and shaking in this moment of realization, what kind of responsibility you have in front of you. They come to me and talk about things they can't talk about with almost anybody in their life. How can we go about it and not be a little bit more, empathetic, emotional, and just vulnerable at times? I think it's absolutely necessary if we take this role seriously. Anyways, I didn't mean to go that way, that far, but you made me think of it. So tears in my eyes here, Robert. Thank you so much for today.
Thanks for sharing.
Before we wrap up, a quick reminder, if you want to supercharge your investment research like I have, check out Tenzing Memo. Don't forget to use code BILLIONS at sign up for your extended trial and 10% discount. It's been a game changer for my process, and I think you'll find the same. Thanks for listening to Talking Billions, and I'll see you next time. You were listening to Talking Billions. We talk about big ideas, big inspirations, big topics. We take on the hardest subject of all, money. But our conversations lead us to an even bigger question: what it means to live a rich life beyond money. If you enjoyed the show, please take a moment and follow, subscribe, rate, and share with friends and family. We rely on word of mouth to promote the show. One click for you means the world to us. Thank you. Until next time, your host, Bogumil Baranowski.